to grow, a significant focus in recent years on data-driven decision-making, and also establishing or encouraging industry for technology-enabled solutions, and also the more recent pilot on establishing an industry standards forum, a forum which looks at newly introduced or yet to be introduced regulations, but analyzes, interprets them so that there is minimal, I would say, translation required and a much higher chance of allowing industry to comply with them. And a lot of this in the last few years has been done under the leadership of Madhabi ji. So with that, may I request Madhabi ji to share her thoughts with us, and she is kindly addressed after that to take some questions as well.
Very good morning to each one of you. It's a pleasure to be here with you this morning. I think every time I stand up to say something, the very first thing that I like to say is that I believe that we are a privileged generation in India. What we are seeing today in terms of the infrastructure that has been built out in the country and where that can take us is so enormous and so exciting that I wouldn't want to be anywhere else on this planet other than here today. Many foreign investors ask us that it's been said for the longest time that India has great potential. What makes you think that this time it's different? And my answer is simple: technology. Because up until now, we had, maybe 10 years ago, 5 years ago also, we had the potential. It was always there. But we didn't have the tools to actually manifest that potential. Today, with the technology that we have in place, starting with the India stack, which has been built, starting with the UPI that the Reserve Bank of India has built, starting with the market stack that our market infrastructure institutions have built, we now have the ability to manifest this potential and take it to the furthest corner of our country. This is the strength on which today 99% of all PIN codes in our country are sitting in our depositories, are sitting in our mutual funds, and that's the coverage that we've been able to get because the technology allows us to make business viable, to take business to the furthest corner of the country and actually manifest that potential. So, all the more, it's a pleasure for me to be here today. When this potential manifests, it manifests also in the markets. And therefore, when we think about the strength of the market, the resilience of the market, the growth of the market, as a regulator, what is it that we believe in? What is our belief which guides every action of ours? That belief starts from saying that the markets need to have a strong foundation. Because if we want the superstructure to go really tall, then the deeper the foundation, the taller your superstructure can be. You cannot have a shallow foundation and expect to build a huge institutional framework on top of it. It simply won't withstand turbulence in the future. So creating that depth and creating the strong foundation is what the role of the regulator is, so as to facilitate that tomorrow the superstructure can be super high for each one of you to ride on. What then drives this strong foundation? The first element of this foundation is trust. And so it is incumbent on each one of us as the constituents of the market to dial up this trust. Whether it is the trust of the retail investor, whether it is the trust of the foreign investor, anybody who is giving us that capital to grow, without trust, there can be no business. And therefore, it falls on all of us together to create that trust, to co-create that trust. What is our belief about how this trust can be built? The first and most important task is for us that the risk management of the system has to be strong. If the risk starts to manifest, as it always does, whether it is external or internal, the risk will be there. But what do we have as a mechanism in the middle that the entire market does not experience a dominoes effect? The wonderful thing about the last few years, 5 years, has been that we've had the opportunity, along with our market infrastructure institutions, to create huge risk mitigation measures in the market. How has that happened? Whether it is in terms of moving to T+1 settlement, and many of you would be aware that we are the first large global market in the world to move to T+1. When I go to ISCO, which is the Global Forum for All Market Regulators, the most often asked question to me is, how did you manage this? And the answer is simple. It takes two things to make this happen. The first is technology, and our technology stack today in our country is unparalleled. We are better than the best in the world. It's been now acknowledged, our market stack. The second is it takes co-creation, because when we work with the institutions and we co-create the methodology of how this will happen, it actually manifests. Because a regulator sitting in an ivory tower and trying to make regulations which finally have to be implemented in the marketplace is pointless. So unless we do everything in a spirit of co-creation, it doesn't get done. So the technology that we've used to bring T+2 to T+1 is now widely acknowledged. As was mentioned, we are now moving to optionally T+0. It will happen before the end of this financial year. And 1 year from there, instantaneous settlement, again optional. Now, what happens when we do this? The risk in the system comes down. Imagine if you had to have, if it was T+2 settlement, you were posting margin for 2 days trades. Now it's T+1, you're posting margin for 1 day's trade. So the entire efficiency of the system has suddenly doubled, because to do the same amount of trading, the amount of margin you need is half. Right? It releases efficiency into the system. Similarly, when we are going to be doing ASBA for secondary markets, most of you are very familiar with ASBA for primary markets, right? That when an investor applies for an IPO, he doesn't actually have to part with funds. The money sits in his bank account and it's blocked there. And only depending on what is allotted, that much money is taken. Meanwhile, it sits in his account. We're now moving towards, and it'll happen maybe January, maybe February, as early as that, ASBA for secondary market. So when you want to trade, you don't need to send your money to your broker. It sits in your savings account, you continue to earn 4% on it, and only when the actual trade happens and settlement has to happen, your bank account will be debited and done. So technologically and structurally, what have we done? World over, the markets are a B2B business. The exchanges and clearing corporations only talk to the clearing members. They have only visibility up to there. The technology that we have now developed it's become a B2B2C business. Our clearing corporations now have direct visibility and control over the last beneficial account, demat account, as well as bank account of every investor of our country. You know what that means from a risk perspective is, the world over, people assess the risk of a clearing corporation by saying, if two of the largest clearing members default, what will happen? In India, we say, oh, nothing will happen. Nothing will happen. We've mitigated the risk entirely. Why? It doesn't matter if the clearing member goes down, because we have visibility to the final investor and we can access both funds and securities. So the level of de-risking that has happened in the market is now a global first. There is no other market in the world that has achieved this. And the kind of trust that this really creates in the system, because there's no vulnerability now to intermediary default, etc., is truly inspiring. When FPIs learn of it, with large foreign investors learn of it, they're truly amazed by what is the meaning of technology and how we have deployed it. The second aspect of building trust is transparency. This is an area which, I would like to quote an anecdote from my investment banking days. I used to have many clients who used to be very irritated when I would say, SEBI wants all these risk factors, 3 pages of risk factors, and they are fretting and fuming, saying, what is this? Kya kare sir, wo SEBI maang raha hai sir. Okay. Now, when a promoter would be particularly unhappy and the team was not able to convince him that, you need to give these risk factors, then they would call me and I would go and I would meet him and I said, truly, I used to say this. Sir, actually, SEBI समझता है कि ये risk factors investor के protection के लिए हैं. Sir, actually, equally, ये आपकी protection के लिए. Because once you have disclosed, what is the implication? Nobody can claim that you have hidden a material fact which may have changed the investment decision. So, in India, we don't have class action suits. We don't have them. In the US, this is so common. The number of listed companies that face class action suits for non-disclosure. It won't be long before public interest litigation in our country takes the form of class action suit. It won't be long. Now the question is, being transparent, whether in the IPO document or subsequently in terms of your filings with the regulator and with the exchanges, means that it protects you. It's like a vaccination for you. It's protection. Nobody can now say class action suit, public interest litigation, because you've been completely transparent in what you have said. So the beauty about transparency is it helps both people. It helps the company, it gives them protection, it helps the investor because now he's making an informed decision. And going forward with the way that artificial intelligence is evolving around the world, you can imagine the power of that engine, to be able to identify 2 things. One is to process what is disclosed and make it much easier for the investor to digest. And secondly, to actually identify that something has happened but you have not disclosed. That's where artificial intelligence is going to take us. So on this path forward, this transparency and disclosure as a building block of trust is critical, not just for the benefit of the investor, but for the benefit of each of the listed companies and, of course, people like the mutual funds, etc., who also have a lot of disclosure requirements. Fortunately, as I said, all of this is being assisted by technology. So in SEBI, we are moving quite rapidly towards doing everything using technology. So many of you would have seen ease of compliance, for instance, automated disclosure, right? The depositories automatically disclose on your behalf many of the things which are required under our SAST regulation. You don't even need to do it now. There's no need. Why should we bother 5,000 people when one depository can do it in an automated way? Similarly, you would have seen automated blocking of accounts of key management personnel. Why run the risk of inadvertent insider trading? It's just blocked, right? So our whole move is that we want to make compliance as easy as possible for all 5,000 listed companies, and the only way that can happen is through use of technology. Similarly, having a RegTech solution. Now, referring to FICCI here, but FICCI has actually put together a RegTech solution. I was amazed that because of the aggregation of demand, the cost per company to use that RegTech solution is really very reasonable. And what FICCI has done is they've already configured that RegTech system for all of SEBI regulations. So any company can just plug and play and at a very, very cost-effective rate, and you're ready to roll and comply with everything in terms of SEBI regulation. So technology we see as the key to good governance and ease of compliance, both at the same time. You can achieve both. There is no trade-off here. There's no need for a trade-off here. Similarly, data. The point was raised about data-based policy making, and this has now become core to SEBI. So we do not look at any proposal unless we see whether A, the problem that is being articulated that we are trying to fix, is it real or is it imaginary in our heads? What does the data say? Is there a real problem? The second is to backtest everything that we do. So anything that comes along, and we refer to, for instance, core ESG, core BRSR. The reason we are so confident that the Standards Forum is not going to have a problem in articulating and specifying the standards is because हमने तो backtesting कर ली. So we've actually worked at the time of formulation of the regulation itself. We have done backtesting and seen, is it going to be easy? Is it going to be difficult? And the backtesting actually showed us, this was a study done by the Chartered Accountants Institute, that 95% of all the data that is required for assurance is either immediately available or reasonably available with the company itself. So 5% is what they came back and said we need to do some tweak because, where are we going to get this data, et cetera, but otherwise it was really simple, the backtesting. So we believe a lot in data, and we are clear that this is very, very important for us in policy formulation, because otherwise we can go badly wrong in terms of our impact on the market. So if we do all of this, what is now the result of this? And this fine balance that we need to have between investor protection and development of the market and ease of doing business. This is an analysis of all the circulars that we've issued, 167 of them. Of course, 167 is across, not everything pertains to listed companies. I think listed companies out of this is only 5 or 6. The rest is all, exchanges, brokers, mutual funds, AIFs, everybody, PMS and so on. All together, if we take, the proportion of our circulars which are developmental and ease of doing business is almost equal to risk management and investor protection. So what the market sees as compliance is that 48%, and what the market sees as making life easier and allowing new things. So what do we mean by development? We define it in a very sharp way. Development, any circular is allowed to be put into the development bucket only if it facilitates a new product. So for the first time, we are allowing, permitting, doing something for a new product, a new service, a new investor class, a new asset class, a new channel, something which up till now was banned, not permitted, etc., is now being facilitated. That's when we put it into the bucket of developmental. Ease of doing business is all the good stuff that, okay, now you don't need to do this, now you don't need to do that, or you do this once in a year instead of twice a year, etc. So the balance that we strike in terms of this is now almost 50-50, as you can see. And our belief is that this number may vary from time to time, but the important thing is we are now measuring it, we are tracking it, and we are committed to it. So in some quarters, in some year, it may be 44, in some years it may be 50, in some years it may be 35. But our eye is on this balance, and we are committed to it. The other thing which has been spoken about the Industry Standards Forum, and I must say, because it's difficult for you to take credit for it, so I need to give you the credit for it, is that this is something that is so important and is working. The early days, it's still early days, the early days, the traction is so positive that SEBI has gone to its own board and stated that while we are running these as pilots right now, we believe that this has the potential to become a permanent, permanent unit of the regulatory architecture. So it is our desire to make this Industry Standards Forum a permanent feature of the way in which the regulator acts. And what that means is that the forum, of course in consultation with SEBI, comes up with a bunch of standards which are very specific. And for each listed company, once that checklist is there, and you say, I have done what I need to as per this standard, there is no ambiguity. It's no interpretation. There is no need for any legal opinion. You are deemed to be in compliance. So therefore, this will just make the whole process of compliance so much easier for everybody, because nobody is having to double guess what it is that you need to do. And including many of the independent directors who come and meet us, they are on large listed company boards, and they say, we worry whether the company is doing it right. And so it's so important that tomorrow if your audit committee says, what is the standard and are you in compliance with the standard, it's just so easy for you to stand up and say yes. So the standards will transform into deemed compliance, and that is why it is so important for us to have this forum. And it's not only for listed companies. We've had a forum like this for the longest time, almost, I would say, more than 5-6 years in the mutual fund industry. It's worked beautifully. We now have one for brokers and for AIFs, etc., across our market participants. But this one, where all the three associations came together, and it was absolutely music to our ears. They are working together in such a collaborative fashion with one voice. I know it's hard at the back to build that consensus. That's not easy. So we really, really appreciate that this is, one of the important elements of regulatory architecture that we need to bring about, on a more permanent basis. This is just, a slide that I like to use because when we talk about technology and risk management, often people wonder whether, there's a lot of cost and so on. And I say, well, of course, people invest, MIIs invest maybe 50 crores, 70 crores. But what is the benefit? This is a per annum number of the technology-driven initiatives that are there. And as I said, the second line, ASBA for trading secondary market, which is the biggest contributor here, is going to deliver to investors 3,500 crores per annum of hard cash saving. This is not a model. This is not hypothetical. This is real money where the entire system will get the benefit of 3,500 crores on an annual basis on account of the technology initiatives that have been implemented in the capital market India stack. With all of this, if this trust has been built, is it surprising? And more importantly, the real economy, as I said, that's like you, right? That's not us, that's just you. With the strength of that real economy and everything that's been built in the markets, today, if you see India's weight in the MSCI Emerging Market Index, which is one of the most widely followed indices globally for investment, India used to have a share which was 6.6%. Today, it is almost 16%. The BSE market cap, which was 74 lakh crores, is now 311 lakh crores in just a period of 10 years. If you look at the mutual fund AUM, asset under management, 8 lakh crores to 47 lakh crores, and I'm told I'm a little out of date here, we're probably closer to 50 lakh crores now. This is the kind of growth we are seeing. You look at the number of unique mutual fund investors. This is PAN level, so not folio level, PAN, these are unique. We now have over 4 crores of these investors who are really, contributing to this stability in the market, because even when foreign money goes out, it may be because of Fed tightening, etc., liquidity in the global markets, the resilience comes because our investors are really coming in either directly or through the mutual fund and through other domestic institutions. While the equity side has grown very beautifully, we at our end, because we want to talk about the future, what is it we believe about the future? And I borrowed this slide from Nandan Nilekani's presentation that he made recently, where he talks about how digital capital can transform physical infrastructure in the country. Now, this is today the example he's given is for NHAI, right? For funding roads. But this is equally true for every part of our economy in terms of every element of infrastructure. It can be ports, it can be airports, it can be power, it can be roads, everything that you can think of. Our belief is, and this belief comes from a very simplistic thought, if you think of all the economic activity that happens because of the 5,000 listed companies, and you say that that is worth 300 lakh crores, we just saw that number, the market cap. Imagine the value of all the infrastructure that is there in the country and is going to be there in the country. And if all of that were to be measured through REITs and InvITs, which is one of our most, I would say, important instruments today that we are trying to grow, it can be a whole additional 300 lakh crores. Imagine in our country, we can double the equivalent of market cap, double it, by simply taking what is now a highly digital capital-based infrastructure in our country, which is becoming more and more so, and transposing it into the REIT InvIT structure, and you can have REITs and InvITs which tomorrow can potentially be valued equally at 300 lakh crores. That's our sense of where India can go. Maybe it will take 15 years, 20 years. But that's the potential that we keep talking about and how it will manifest. And therefore, we have a lot of emphasis in SEBI on REITs and InvITs. And of course, as you know, in our country, REITs and InvITs are interlinked because the viability of infrastructure projects comes from the value that is created in the real estate when that infrastructure comes up. So when you build a road, the real estate around the road gets value, and therefore the two are linked. So that's the value that we see. And we think that this is the opportunity for all of us sitting here to double effectively the market cap of the country. Where are we on that today? So if we look at today, market-led capital, okay, what is it that is being raised capital from the banking system versus from the market? So if we include corporate bonds, REITs and InvITs, and we compare that to the outstanding bank credit to industry and services, today we are at about 66%. So almost 2/3 of what the banking system gives to the economy in terms of debt, 2/3 of that is actually coming from the marketplace in one form or another. And to end, where do we think this is going to go? What we're delighted with is, on a lighter vein, thanks to the immense efforts of the government and the Reserve Bank of India, the Indian sovereign bonds are now going to be part of the global indices. This is hugely important for us as a country, not only because it will help in the government raising resources, but once the Indian yield curve is established globally, on the back of that, the corporate bond market can also get a lot of traction and a lot of interest from foreign investors. And so we are hoping that down the line, it will be a case of, my name is Bond, Indian bonds. Thank you.
Thank you very much, Mrs. Buch, for that wonderful, comprehensive, and so professionally done presentation and your comments. It was of great value, and I'm sure this house is so much more enriched. I only have one comment to make, and that is, I think the SEBI chairman has essentially talked about a 360 degrees trust, 360 degrees building of trust. And I think that was a key point, a trust-based regulation. Really value that, Madam. And we look forward to working with SEBI from the Indian industry in really building upon the trust and this format of partnership that you have laid forward. Thank you very much for that. We will open it up to the floor for questions, but I must give the first right to Sanjeev, the chairman, for the first question, and compliment of what was happening behind the scene when she was speaking in the market.
No, so I think the biggest compliment, unintended, is the market has opened at an all-time high. So great testament. Of course, I must clarify, I'm joking, because we can all get stuck in the markets. But no, great presentation. As CB said, gives us a 360-degree view. I wanted to focus on one particular aspect, which is, you talked about it as well, the focus on SEBI to really use data and technology-enabled solutions to help drive decision-making. And that brings in a significant amount of pragmatism and transparency. You gave the example of a good RegTech initiative as well. You mentioned something called FICCI. We don't know what that is. But more seriously, I think it's a great initiative. Is there a roadmap that's available or that we can work with SEBI, all industry participants, to say that, these are 1, 2, 3 things next that are material and we should take up? So any thinking from your side on where SEBI is headed will be useful to us.
Absolutely. So, this links back to the question of standards. So the single biggest trend in terms of regulation and regulation-related compliance that the market should expect to see is greater and greater automation. So as I said, one half of that automation will be to ease compliance, like automated disclosures, etc. The other part will be what we call suptech. So when we do supervision, we are also going to be using technology. So we're not going to do Baba Adam style inspections and, examinations anymore. So for that, what will have to happen is that there will need to be data which is there in a very standard form, and we've moved practically I understand about 70%, of reporting is XBRL. We will now probably need to move to more and more. I understand that we can theoretically get to about 80%, maybe not a lot more than that. So a lot more of XBRL reporting and a lot more of automated supervision. So we will be developing a lot of alerts. We already do that for a lot of our regulated entities, where the emphasis on a human being examining something is now not relevant. Instead, we deploy algorithms to do that. So say, for instance, in the context of listed companies. So our artificial intelligence will scan the environment to say that is there anything which is happening in the context of the name of a particular listed entity coming up again and again. If it is, then the question is that has there been a parallel disclosure, right? So then this will all be automated. So people need to anticipate that going forward with artificial intelligence, the need for being proactive in terms of disclosures, etc., will automatically happen, because suptech will also use technology just as regtech will use technology. And that is one trend, this whole technology piece. The second is this whole ease of doing business. So as far as we are concerned, and I've said this on occasion before, that the fundamental role of the markets is capital formation. Everything else is incidental. So, and which is why we are so, I would say, committed to this next 300 lakh crores, because that's where additional capital formation is going to come from. So what is it that we can do to make that work for you? So for instance, we created a specially focused standing advisory committee on REITs and InvITs, and the terms of reference of that committee were completely different from what we have ever done in the past. What we said is, each subsector of the infrastructure space is unique. We have no desire to have a one-size-fits-all, because if we do a one-size-fits-all, we have to have risk mitigation across 10 different asset classes. And then guess what? It's just too tight a regulation. So we are quite happy to say, here are homogeneous sets of, subsectors. Each of these needs only 1 or 2 risk mitigations. Now allow us to raise capital with just the minimum regulation. And that is the mandate given to that committee, saying, come back to us, and whatever the market wants, subsector by subsector, we are here to craft our regulation in response to your need. Not the other way. It's not, we have made a regulation, now maybe we'll do a little tinkering based on what you say. No, no. This is very fundamental. So this is the second big theme for us going forward, that there has to be a focus on capital formation and there has to be an ease of compliance, otherwise we can't grow the economy. The third trend is really in terms of what I would call, and I would emphasize again, it's sort of linked to the second one, but the emphasis on co-creation. So if CII were to want to plan for the future in terms of how do we work with SEBI, for instance, to me, it's crystal clear. The Industry Standards Forum is the way to go. And if the practitioners come, contribute their knowledge, experience, understanding to that, then the entire system can be such that you get both. You get good governance and you get low cost. So that co-creation aspect is really very important, and that's what I would request CII to really invest in and work very closely with us.
Thank you. CB?
No, thanks, and we shall actually work in that direction. Not comment anything at that point in time because, ma'am, we've spoke just before you came in, and you've given us some great ideas when we were speaking to you earlier and just now. We will create that capacity within our institutions to see to it that we are able to have that quality interface with your institution. We talked about enterprise, we talked about startups, we talked about how they have been growing some time back, and some of them are amazing stories. And I want Kunal Bahel, the co-founder of Ace Vector. Kunal, would you like to go ahead?
Good morning. And Madam Chairperson, your discussion on technology was music to my ears as a technology entrepreneur and investor myself. You know, time is money, and I think you've mentioned this in your talk also. In this fast-paced world of new age startups, many of whom are looking to access public markets, and I feel our public markets will have hundreds of them in the coming years. What would be your advice so that they can get faster approvals and thereafter have lives as successful public listed companies in India?
So that's a double-barrel question, so let me attempt to answer. So on speed of approvals, I would say that we had a lot of work to do internally in SEBI, which we have done over the last, I think we've tracked the last 6 quarters or 7 quarters. You know that typically in a government institution, accountability typically is how long did you take after receipt of last information. So that gives a government officer, SEBI officer, a lot of leeway to say, oh, my clock is ticking, it's almost time, let me ask one more question, and then I get a reset. It's very convenient, right? Now, what we have done internally in SEBI is we've changed. We said, your performance appraisal, forget what is legally required. Legally, that continues to be required. That's how all government things are. But for your performance appraisal, you will be judged based on date of first application. So if the application is incomplete, feel free, return it and say this is an incomplete application. But if it is complete, your clock starts from there. And now, you know, I don't have that slide with me, but we track this on a quarterly basis, and the chart is truly amazing. I mean, this is one thing that I really give a lot of kudos to the SEBI team. The pendency is coming down, and more importantly, pendency in itself is not bad. If a lot of IPOs come, pendency is good. But the aging, the reduction in aging is dramatic. And in fact, I recently took stock on the IPO side, and I saw three items which were still more than 3 months. Because now in SEBI, anything more than 3 months means it's a crime. I mean, chairman's office is going to call and you will be hauled over the coals. Why is this pending more than 3 months from date of first application? And when I asked why is it pending, and then we had a discussion that when there is either a judicial intervention or a pendency due to another regulator's NOC not coming, then, you know, unnecessarily in that sense it shows up as our pendency. So we've actually said, why don't we move into an in-principle approval or a subject to approval, conditional approval, कि हमने अपनी तरफ से देख लिया, we are absolutely fine with it. Now something is pending from another regulator or something. So subject to that, you're good to go. So that is the level of focus that we have on saying that if a company needs to come with an IPO and the timing is right, we can't let them lose that opportunity. So the aging today is really very good. So from our side, I think we've done a lot to bring down that aging. There used to be a time it used to be like 1 year, 2 year pendency. That's all history now. But from the issuer's point of view, and this is another area where industry standards can help, we have asked the industry to say, you give us sector-wise, saying these are the standard risk factors, etc., and standard disclosures which are relevant sector by sector. And we've identified some 10 or 12 sectors. What that then means is, if you belong to that sector, you know exactly what SEBI is going to ask, because over the last 20 years, that list is there. So we've told, I think, the Association of Investment Bankers, if I'm not mistaken, that you have this whole database. कि SEBI normally क्या पूछता है? तो why are you waiting for us to read the document and ask you? आप पहले ही कर दें, हम वही सवाल पूछते हैं. We don't invent anything new. वही के वही सवाल आते हैं. So that association, once they come up with this, I expect that I can start monitoring 1-month-old cases and not 3-month-old cases. But that requires the work from the Association of Investment Bankers.
Thank you. Lots of hands I can see. I'll try to do first come, first serve basis for a few. Nitin Shukla, who's been heading listed companies and now independent directors in many companies. Nitin. Yeah, there's a mic.
First and foremost, compliments, because regulator has such an important role to play when we are moving from a controlled economy, so to say, to a market-driven economy, and compliments for that. By and large, human beings' actions are influenced by what they say, bhiti and moh, lalach and dar. To answer that, the checks and balances are in place to ensure that it does not happen. Having said that, there are always, whether the checks and balances are perfect or there are too perfect so that hardly anything moves. These are two contradicting or conflicting requirements. How do you manage that, madam?
So you're very right. Again, I will take you back. Fortunately, I come from where you come. So I still remember when I was on your side of the table, so to speak, I once was addressing the audit committee of my company, and they were asking me to tighten controls. And I said to them, very easy for me. I can tighten these controls completely. But you know what? Then I'll be building a Fort Knox, and even customers won't be able to come in. Right? So I come with that orientation that there is something called risk-based regulation that is required. And depending on the risk, you have to have suitable regulation. So if you see, almost everything that we do is actually risk-based. So in respect of listed companies, for instance, if you're a relatively smaller company, the compliance requirements are much lower. The top 100, 150, 250 companies have many more compliances because their impact on the market is much larger. If there is some major blow up there, the impact and the number of retail investors it affects and the global sentiment it affects is much larger. So in listed companies also it is risk-based. Whether it is in terms of asset classes, mutual funds get retail money, so they are more tightly regulated. PMS, minimum entry is 50 lakhs, so it's less tightly regulated. AIFs, minimum entry is 1 crore, it's much less regulated. So everything that we do from a risk-based perspective, so that you're not impinging on the ability to actually keep running your business. Now, having said that, I would like to underline one thing because, this is sometimes something which is not commonly understood. For listed companies, we are not like a sectoral regulator. So let's say SEBI regulating a stock exchange or RBI regulating a bank, you're a sectoral regulator, right? So you tell your regulated entity what you can do, what you cannot do. That's not the case with a listed company. If you see, every regulation that SEBI has qua listed companies falls into only 2 buckets. Please disclose the following things and please take the following decisions to the following committees. Just think about it. We never interfere in your business. We never tell you what to do, what not to do. The way that we, let's say, tell a mutual fund or RBI tells the banks, we never tell you what to do or what not to do. That is entirely your business. We only tell you these two things. Please disclose the following things, and please take the following things to the following committees for approval. So to that extent, I think the more that this gets standardized, it will just get easier for everybody, and it should just be like, it should just be something which does not even come to the attention of a CEO, because it's just so streamlined that it has to be done. It's done, nothing to be done. That's where we would hope it would go to.
Thank you. Chenmay? Dr. Chenmay Sinha.
Thank you for a really clear exposition of SEBI's focus. It was really refreshing, and the two factors that I will say that really struck me were the collaborative view, and your slide on showing where the circulars are being issued was something I think all regulators should be forced to do. So congratulations. Just as people saw that you were going to be here, some of my clients have sent me a question to ask you. So if you don't like it, don't blame me. Huh? The random allotment system for IPO and the retail and HNI system needs to be understood better. And why was the pro rata formulation stopped? Some of my iBanking clients are asking me to ask you.
Certainly, I have a very simple answer. The level of oversubscription in IPOs, to our mind, was getting inflated because of the pro rata mechanism. So if somebody wants 100 shares, the investment banker, like I was and I did, I would go to my client and say, I expect this issue to be oversubscribed 20 times. So if you want 100, actually apply for 2,000. Okay. Now, as a result of this, the price discovery mechanism was being corrupted, because it was appearing as though I want 2,000 shares. Actually, I don't want 2,000 shares. I only want 100 shares. Right? And this process was leading to a certain unnatural, I'm trying to find a politically correct word for it, an unnatural price discovery. See, we have always said that SEBI will never sit in judgment of what is the price of an IPO. The market will decide based on demand and supply. That is how prices are discovered in a free market. But if your demand is being inflated because of this, the way in which allotment is done, so our regulations were encouraging that a person who actually wants 100 shares is putting in an application of 2,000. Okay. And on top of that, this was also resulting, of course, in a lot of leverage. And so you may have noticed that the Reserve Bank of India also issued a circular in terms of funding of IPOs, etc. So this was a phenomenon happening in the market which was not healthy. And therefore, the question is that what is it that you need? This is the way, the new formulation. And by the way, for retail investors and to a certain extent HNIs, on the very next day or the next day or the next day, there's enough liquidity in the market. See, what I don't understand is if somebody is just putting a punt, saying, I expect this to pop and become double time, then you're not an investor, you're a speculator, right? So then, boss, it's, it can go either way. But if you are actually an investor in that stock and you think it has long-term this thing and you want to hold that stock, please buy it on the 3rd day, 5th day, after 1 month, after 3 months. Right? Institutions can't do that because they need big blocks and they move the market. But you and I, with our kind of money, we can easily do it. So we were trying to correct a mechanism which was unhealthy in terms of inflating giving an impression of much higher demand than there actually was.
I think we have over short time. If you allow, may I take one more? Bharat Joshi. Yeah, there's a mic on the right.
Thank you very much, CB. Ma'am, thank you for a very articulate explanation of how you're using technology. We're in the logistics business, and the way we see it, we saw all those J-curves of how the markets are rising. So we see that. We also see the way the Indian economy is rising. Now, for firms like us, this is an unprecedented opportunity, and one that will require capital to fuel our growth and the way we can support other companies. Now, how do you think we could access primary markets, and what is SEBI doing to promote this? Thank you.
So, as I said, the capital can come in any of these three forms: equity, debt, or hybrids. Our belief is that on equity, the market is quite mature. So, we've not received any feedback to say that we are not able to raise capital because of this part of your regulation. We've not received any feedback. If we do, we are very happy to look at it. We've received a lot of feedback on saying for development of the bond market and the hybrids market, this is what we would like the regulator to do. So I think our focus on facilitating that is there, because that market needs to be bigger and better. But really on the equity side, it's the way we see it, it's really demand and supply. When valuations are sensible and there is demand, IPOs happen. When expectations are unreasonable on either side, either on the side of the investors or the promoters, transactions don't happen. So we don't see much role for ourselves over there, to be honest.
We are really running out of time. We have Secretary DFS, Secretary Labor, Additional Secretary Logistics, all here for the session next, and we have actually borrowed extra time from her. So I'll hand over to Sanjeev to wrap this session up.
Well, actually, there isn't much to wrap up. We've seen very clear articulation of SEBI, direction in which SEBI is headed, the transparency, the pragmatism that data will drive, the collaborative efforts that the chairperson has not just talked about, but has already started. And with industry associations, we know what we are doing to support it going forward. So thank you once again for making time out to be here with us today.
Thank you.
Thank you. Thank you very much. Thank you.